Good afternoon. It's Wednesday, the 13th of January 2016, just after 1 o'clock. Welcome to UK Column News. I'm your host, Mike Robinson. And joining me today, I'm very pleased to welcome Paul Gallagher from LaRouche PAC. Hello, Paul. It's been a long time since you've been on the programme. I suppose I could say Happy New Year, but for many people, it's turning out not to be quite that, isn't it?
This was something that we forecast. I should say thanks. I'm glad to be back on. But it certainly was a date that LaRouche pointed to along about the 20th of December and said, January 1st, watch out, bail in, this is going to start a blowout.
Right, so Reuters, as we reported ourselves, I know you reported this as well, Reuters a couple of days ago has highlighted the fact that one of the key problems is the fact that the bond markets have completely seized up. And Reuters pointing out that this indeed is at least partly a result of the bail-in policy, which has come into effect on the 1st of January. What's your reading of this? Is the bond market loosening up? Is it getting tighter? This is really not going to go anywhere but badly. Is that an unfair statement?
No, not unfair at all. This is the bond market for banks that completely ceased to function basically in the first week of the new year in Europe. And they've made the intention pretty clear in imposing the bail-in policies, supposedly starting on the 1st. That's when it became mandatory, but it was already being applied to smaller banks in Portugal and in Italy before that. They made it clear that this is in part an intention that the smaller banks be cut off and disappeared. They expect, there was a big article in Handelsblatt, for example, last week, Europe's zombie banks. But they, speaking for Wall Street in London, they identify the wrong banks as the zombie banks. They mean the savings banks, the IPO bank, the Landesbanken in Germany and so forth, the community banks, which they intend the bail-in policy to wipe out completely. And so a sign of this is the fact that banks can't make it to the bond market in 2016 up to now. And there is also a tremendous amount of flight capital already seen, even in just the first 2 weeks. Flight capital from Italy, Spain, France, interestingly, that is flight capital out of bank accounts of various kinds in those countries into Germany, the Netherlands, Luxembourg, which can be seen by looking at the Target 2 ratios and so forth. But since the bondholders and depositors now expect at least in those countries of Southern and Western Europe, they expect that they'll be expropriated. Naturally, bonds can't sell from those banks, and money is flowing from those banks as rapidly as possible to get out. So you're building in a significant wipeout of banks in Europe, which the Wall Street and London crowd imagine can be stopped at the border, and it will leave a few really gigantic banks untouched. But that's not at all the way that LaRouche or that we see the process is going to develop in the coming period, because bail-in is not the only thing that's happening.
Well, indeed, and of course we've seen massive falls in the stock market in the first part of the year as well, and rather stupidly, perhaps, this is being blamed on China. But it's not just the stock market, it's not just the bond market, it's also physical commodities and a whole bunch of other markets as well. So, I mean, it is perhaps a little ironic, isn't it, that China is receiving the blame for a lot of the problems that are existing at the moment, and yet 2015 was the sort of biggest inflow of capital into China from foreign investors that we've seen so far. So people don't seem to be able to make up their minds what is correct.
This is just propaganda. Absolutely, Mike. I mean, China's stock markets account for something like 2% of the volume of stock market trading in the world, and the US and Europe for something more like 60%. So China's stock market is not causing any of this to occur. Rather, I think it is significant that China liberalized its capital account over the course of the last 2 years. In other words, to state it in simple terms, they made it possible for capital to leave China without restrictions and go invest somewhere else in the world without getting authorization from the central bank as previously. So they got a lot more volatile as a result. At the same time, they were hit with the fact that the US and Europe stopped importing from them on anything like the scale that they previously had been doing for manufactured goods. But China still, and I think it's interesting that evidently today, or this morning in Asia, China has reimposed capital controls in effect by a directive to the banks to again require authorization for capital leaving the country. But still, China has a 7% growth rate. The United States looking like it has a 1.5 or so percent growth rate in 2015. Europe more like 0.5% or less. And China has the investments going on in real physical productivity, in real new technologies, both inside the country and also through its various Silk Road funds and the AIIB now outside the country. So it's still providing the engine for growth and technological change, which it has really for the last 10 years. And it is not in any way triggering or causing this collapse in commodities, which really is the underlying driver of the crash that's going on.
So would you agree that this collapse in commodities is really representative of a collapse in productive output in the West, since China actually has been manufacturing quite a lot of the raw materials, never mind the end product that we have been consuming over the last couple of decades. And I mean, there are now multiple stories appearing describing how global transport, global shipping is collapsing. We've got the Baltic Index at the lowest level it's ever been, and so on. So this must be this is really the key point here, isn't it? That it's a Western collapse. It's not a Chinese collapse at all.
Yes, it may not be fully realized by a lot of your audience that for the last 10 years, shale oil and gas in the United States has been it. Aside from the subsidization of the auto industry's minor comeback, which was accompanied with a lot of more outsourcing of production out of the United States and also a 50% cut in wages. Other than that, oil, shale, and shale gas have been it. That's U.S. capital investment for the last 10 years. There really is nothing else. And immediately when the price of oil started to collapse back in 2014, with the Saudis initially thought they were pulling a nice trick and were going to strike Russia and strike the U.S. shale producers, and they set off something they couldn't control. Once that happened, to me, immediately at that time, the end of 2014, when we introduced our new Silk Road report, I said already at that time, if this oil price continues at this low level or goes further down, then in the course of 2015, then by the end of 2015, we'll be in a crash because there is no other engine, has been no other engine in the U.S. economy. There really hasn't been any in the European economy. And at the same time, the oil industry as a whole, combining both the shale wildcatters in the United States and the big majors, the Shells, the BPs, and so forth, the oil industry as a whole since 2005 has enormously indebted itself and completely changed the relationship between its revenues and its debts, such that it made itself, once commodity prices started to really drop, it made itself the trigger for the next global crash. Essentially, it made itself the subprime mortgages of this thing that's developing right now.
And of course, there are no, at least if we just look at the infrastructure that's available to the financial system and governments as they are based on the policies that they have at the moment, there are no solutions there. In the 2007, 2008, they printed a lot of money and they bailed out the banks. Now they've moved towards bail-in. But actually, there's nothing in the economy that can sort of take up the load of this massive black hole they've created for themselves.
There's nothing until governments put it in. That is by national credit. There is nothing that can sustain these immense debts. I mean, we estimate the total international debt and derivatives in the order of $1.5 to $2 quadrillion at this point, with the bulk of that being in the derivatives market. But in the remaining productive industries, this burden of debt has become immense. Basically, everything has been financialized, securitized, so that debts are piled upon debts, debts are all collateralized and piled upon debts, and then derivatives piled upon those debts. Everything is, the banks are chock full of bad loans. The European banks, perhaps somewhat more than the US banks, but basically they're all chock full of bad loans, worthless assets, and the collapse of commodities over the last year has exposed just how worthless those assets are, coming on top of a preceding collapse in real estate values, which really didn't rebound. So that now there's nothing to provide productive credit. It's not coming through the banking systems of the US and Europe. It won't come through them. We really need to shut them down, reorganize them on Glass-Steagall principles immediately, shut them down so that government credit, national banking credit, can go into producing productivity in the economy again.
Okay, you've used a couple of phrases there that not everybody will be familiar with. So let's talk about government credit if we can for a moment.
Okay.
Because many people wouldn't see the difference between government credit and, for example, quantitative easing. So can we just touch on that a little bit and explain the differences and why one works and one doesn't?
Well, it's good that yesterday was Alexander Hamilton's birthday. In fact, we had a big rally on Wall Street near his statue, where they were also having an event in one of the institutes there that studies his work. And that was really it caused quite a furor there on Wall Street with that, as cold and windy as it was. But Hamilton established principles of national banking which definitely excluded lending, a national bank lending money to the government. This is something that really draws a dividing line, in a sense, between quantitative easing, which is the end of a long, centuries-long legacy of what used to be called central bank, the Bank of England, the merchant banks, which were formed in order to lend money to governments, in order to indebt governments so that they could then control who were the ministers, what were the policies, based on the fact that they utterly controlled the financial strings of that government through debt. That was repeated over and over and over again. Hamilton's national banking policy was literally the opposite of that. He said that the government needed a bank, first of all, in order to reorganize its own debt. so that that debt could be extended in time and also reorganized on better terms with the private individuals who owned the government's debt. In other words, that the National Bank would be the intermediary between the government and private banks. It would be making loans to private banks which bought government debt, and it would also be making ordinary commercial loans to companies, to at that time, to the canal companies, the Erie Canal Company, later the Second Hamiltonian Bank, all the railroad companies and so forth. It made loans like a commercial bank, not like an investment bank. You could open an account you and I could open accounts in the Hamiltonian National Banks of the United States, and it directed credit based on the holdings of government debt in the private economy. It directed credit to those enterprises which were building the new technologies, right? Which were spreading the most important new infrastructure technologies in the 19th century, and over that course of that time, made the United States the industrial power that it was. And the lending of the national banks was always directed into the industrial economy. Now, we had Franklin Roosevelt, whose policies we have to really seize onto now to get out of this crash. Franklin Roosevelt intended to create another national bank in the 1930s. He wanted to put industrial lending banks in each of the districts of the Federal Reserve, each of the 12 districts in the United States where the Federal Reserve has banks. He wanted industrial lending banks in each place with a capital of about $500 million each. In the 30s, that total of $6 billion to loan was a lot. And he wanted those to restart crucial lending to industry and also to regional and local infrastructure projects. Unfortunately, he was blocked from Congress by doing that. He instead went the route of the Reconstruction Finance Corporation, which was much more of simply an institute which borrowed money from the public based on a guarantee of the government and then invested it in the most important aspects of productivity. But all these periods when the United States has really progressed has been based on going back to one form or another of that Hamiltonian banking. Quantitative easing, as you indicated, is entirely different. Then you have a central bank which is lending money in large volumes entirely to private banks, and really entirely to large private banks. And it is also then directly buying securities from those private banks in order to give them capital reserves. So you have a situation where the bank exists for no reason except to create excess reserves in the big private banks. And the more the crisis hits, the more it attempts to create more and more and more excess reserves in the private banks until the process explodes.
Indeed. Now, of course, any time that I've communicated with a politician or a central banker like Mark Carney, for example, on the issue of national credit, one of the excuses that is given for not implementing such a policy is that it would be hyperinflationary. And of course, this is one of the allegations or one of the facts of quantitative easing. Now, why, in that case, would a Hamiltonian national bank issuing national credit in this way not be hyperinflationary?
Because it increases those kinds of investments increase the productivity of the labor force as a whole. And that was consciously, if anyone reads the report on manufacturers of Hamilton, if anyone reads the 4 basic reports that Hamilton made to the Congress in 1791 and 92, they will see that he very consciously delimited the investments which should be made through national banks to those which increased the productivity of labor in the economy as a whole. In his time, it meant shifting the American population gradually from farming, which would be itself increased in its productivity by such investments and trade, shifting it into increasingly manufacturers. This was very controversial for him to take this stance at that time, but that's the way he defined the purpose of investments through a national bank. And well, you can take it to the current period of China's banks, which certainly have not been pursuing just a neat Hamiltonian policy. China's state banks in the last decade have issued $20 trillion worth of credit. This makes the Federal Reserve look very small by comparison. And that credit has tended to go in all directions. So that obviously some bubbles have been built up in the Chinese economy. A lot of credit has gone into what's now obsolete manufacturing capacity, which is now obsolete. But at the same time, there has been a tremendous investment in productivity drivers like high-speed rail. They have built a high-speed rail network of 12 or 13,000 miles in one decade. Other productivity drivers in the power industries and so forth. And they have really, through those investments, provided, even Wall Street estimates, provided half of all the real economic growth in the world for the last decade. This has not been an inflationary period since the crash of 2007, 2008. When investment increases labor productivity in that way, it does not, because what is being produced can now be produced more effectively, more productively than before. The production and sale of those goods is not inflationary. With quantitative easing, the hyperinflationary effects are delayed sometimes for a long time because they are proud of the fact that they're lending money only to banks and that it doesn't get into the real economy at all. It stays in larger and larger and larger excess reserves in those same banks held at the central bank. So it doesn't touch the economy. And as even Ben Bernanke argued at one point, it doesn't therefore cause inflation, until, of course, it does. When all of a sudden a deflationary collapse such as is going on flips into a hyperinflationary one, then all of a sudden it does. Until then, it inflates the prices of assets, financial securities, but nothing else.
Now, one of the other reasons not to implement national credit that I've heard is, of course, that politicians can't be trusted to run these types of organizations. I mean, what do we say to somebody that makes that argument?
In the United States history, national banks have not been run by politicians. They've been run by bankers. Generally, 80% of the boards of directors of every branch of each of the U.S. national banks have been businessmen and bankers from the district of which the bank was servicing. So, and that I think should be the case again. These are not, we don't require Soviet-style national banks in which government officials are deciding on every allocation of credit. What we require is banks which are capable of generating credit and directing it into, for example, the Reconstruction Finance Corporation, which was run for almost its entire existence of nearly 20 years by a banker from Texas. And in fact, a group of bankers, Jesse Jones was the banker from Texas who headed the Reconstruction Finance Corporation. It, for 20 years, as its final report emphasized, did not seek profit as its primary goal, but rather sought the objectives of economic growth and productivity of the nation as a whole. And yet, over that 20-year period of time, it made, in fact, a very nice profit in investing in every conceivable necessary kind of mobilization of the economy, both in the New Deal and in the war. And that there are certainly bankers, and I know some in the United States, and regulators who were bankers before they were regulators, who are perfectly capable of organizing the activity of a national bank. It doesn't have to be a function of the Treasury. It doesn't have to be a government institution run by government officials.
But it would operate under government policy, so government set policy. Is that what you're suggesting?
In the sense that obviously the most important productivity missions, infrastructure missions of the nation will be implemented through that bank, in the sense of John F. Kennedy's launching of the Apollo project and the tremendous expansion of the NASA activities in the United States in the 1950s and the 1960s. This was obvious to him as president and to many who worked with him that there were certain great projects of infrastructure involving water in the West, for example, another concentration of his, and that these kind of investments require more than private companies or private banks will do, and that therefore they're going to be pursued. This has always been the case, but this is quite evident to reasonable and experienced private bankers as much as it is to government officials. So yes, the purposes of the nation, in terms of the productivity of the labor force of the nation, these are the purposes of a national bank.
Right, and the other term that you used there was, of course, Glass-Steagall. You've been talking about it for years. We've been talking about it for years as well. And but aside from the separation of commercial banks from investment banks or merchant banks, there was other stuff around that act which maybe isn't talked about so much in terms of the quality of what would be classed as a legitimate debt, for example. So give us a bit of a rundown on exactly what Glass-Steagall represents and how it would deal with the current banking crisis.
Well, it's interesting that just in the last week in the United States, there's been a tremendous flurry of debate over a speech that the Democratic candidate Bernie Sanders made last week, in which he said, and this is absolutely true, but it's the first time that an advocate of Glass-Steagall on the national political stage has said this, that it would have prevented the 2008 blowout, because it would have prevented by law commercial banks, which of course have most of the money in banking, from making massive loans into shadow banks. And therefore, by shadow banks, understanding investment banks, hedge funds, private equity funds, and so forth, money market mutual funds, it would have prevented the commercial banks from transferring their deposit base by loans into these other kinds of speculative institutions. And therefore, it would have prevented these shadow banks from blowing up the economy. So he directly attacked the argument which is often put forward against Glass-Steagall by Obama, by Tim Geithner, and so forth, that the banks, the institutions that failed in 2008 in the fall, and before that were investment banks. They were not commercial banks. They were an insurance company, AIG, so on and so forth. This is a very facile and nonsensical argument, but it's the first time that on that level of national attention, this feature of Glass-Steagall has been brought out and argued over, that under Glass-Steagall, it's not just that the banks and the investment banks and the insurance companies are all thoroughly separated from one another, but also that commercial banks are protected from themselves. And there even was a Supreme Court decision in 1971 in the United States which upheld this very principle. Commercial banks are not permitted to make loans to any institution for the purpose of carrying broker-dealer activity or securities activity. And they are not allowed to, no one is allowed to transfer risky securities from any kind of division or institution onto the books of a commercial bank, which enjoys federal insurance and then other federal protection. So that the speculative mass could not be fed by the commercial banks in the way that, for example, with the London Whale, in the way that J.P. Morgan Chase took a huge chunk of its depositors' money, transferred it to this London operation, and invested it in the derivatives market, and lost a huge chunk of it. This absolutely is forbidden to commercial banks by Glass-Steagall, and it's if we impose Glass-Steagall now, the point is that all of the typical big bank now has thousands of divisions. They're all engaged in all of these kinds of speculations and in all of these ultimately now worthless assets. If you impose Glass-Steagall, the commercial bank has to cut all of those off, has to get rid of them and cannot deal with them in any way, cannot lend the money. Those are going to go bankrupt. That's what LaRouche means when he says shut down Wall Street with Glass-Steagall. If it's passed and if it's enforced, most of the divisions that are now part of these huge mega banks are simply going to go under. They're going to go under very quickly. And you really are going to shut down Wall Street operations before they completely explode. Then, as happened with FDR in the 30s, he was quite frank about this in press conferences. He said, it appears that we have just removed billions of dollars from the financial system. We now have to replace it. He said, I don't know that those billions of dollars were real to begin with, but it appears that now it's gone. So we're now going to replace it by federal credit. Ultimately, it came through the Reconstruction Finance Corporation, the TVA, and other famous projects. We're going to replace it, and we're going to replace it with credit that provides productivity. So Glass-Steagall opens the door by starving, instantly more or less, starving the non-banks, the shadow banks, which are have become larger in gross than the commercial banks themselves. But that's happened because the commercial banks have transferred so much of their deposit base by lending. So that's the crucial thing. And it's got to be done right away. It's important that it's in the Democratic primary race in a big way here in the United States now. It may very well soon be a really major issue of the general election, but we don't really have that much time because the banking systems, particularly in Europe, are getting ready to blow out now.
So why has Bernie Sanders done this? Is this just to get at Hillary, or is it to draw the teeth of Martin O'Malley? What is the, or do you think he's actually genuine about this, about the comments that he made?
Because Hillary Clinton is a mouthpiece for Barack Obama and also is effectively acting on Wall Street prompting in the campaign. And she started a kind of a campaign to say, no, Glass-Steagall, I have better ideas, she said. Glass-Steagall is not the way to go. I have something real complicated that I can't quite explain to you, but it's better than Glass-Steagall. This is Wall Street's line. Anything to them is better than Glass-Steagall. Anything at all. Dodd-Frank was their firewall against Glass-Steagall being enacted here. So Hillary Clinton tried to downgrade and attack the Glass-Steagall Act as something which would not work in the current crisis, would not have worked in the 2007-2008 crisis, And Sanders responded, and so did O'Malley. Sanders got a lot more publicity for his response than Martin O'Malley did. But they both responded simply with the truth about the Glass-Steagall Act, that it is the most pungent and most forceful tool that we have right now to bring this collapse up short by shutting down the City of London and Wall Street casino operations. And it will work to do that, and it would have prevented those casino operations from blowing up in 2007, 2008.
So the combination of national credit and Glass-Steagall perhaps would allow us to avoid headlines like this in today's or yesterday's Daily Mail. 2 million workers trapped in low-skilled jobs, and as you reported earlier today, the same kind of Paul Craig Roberts here talking about the same kind of nonsense going on in the United States with low-quality, low-skilled jobs. In a sense, we're in a pretty good position, are we not? Because if we were to implement these policies, we have the opportunity actually to completely rebuild and train people up in potentially in careers that they had no hope of getting an opportunity to be part of maybe 20 or 30 years ago.
I think it's going to be a slow, and I know that Lyndon LaRouche thinks that it's going to be a slow process of recovery. We can get it started immediately. We know what the most important national infrastructure investments and national crises are to tackle in the United States and also in Eurasia through China. It has already been defined what are the most important rebuilding steps that can be taken. So in that sense, yes, I mean, you can look at the extraordinary partnership that's formed, for example, between the southeastern European countries who have their own association called CEE and China, where they've actually made the Prime Minister of China a member of the heads of state of the southeastern European countries. And the rebuilding of, in some cases, the building of railroad links up through the Balkans into Austria, Hungary, and further north into Europe is taking place with Chinese investments. It's the one thing going on for Greece. It's the one lifeline that Greece has had, is that the Egyptian canal has been doubled, and so Chinese ships coming through there now aim for Athens as their first port in Europe, and then need rail transport, high-speed freight rail transport north from there through the Balkans into Europe. This kind of development has been going on in a lot of different projects in all of those countries, and the land bridges across Eurasia are very well planned out. Helga and Lyndon LaRouche have been planning and writing them for 30 years now, and they've become Chinese policy. So with cooperation from European governments creating credit to cooperate with that kind of infrastructure development, as also on the U.S. side, yes, it's ready to do, but we have lost tremendously, and so have many countries in Europe have lost tremendously in our workforce, in its skills and in its level of culture, and its real demoralization. There's been one, you referenced that analysis of the so-called wonderful jobs report last month in the United States that Paul Craig Roberts did. I've analyzed previous months during 2015 and 2014, found exactly the same thing. A lot of jobs are being created for older people. They're being taken by people over 55. And one of the things he drew out of this December report is that well over half of all the jobs reportedly created went to people over 55, and they were taking second jobs and third jobs. These are older workers who can't retire, who have no possibility of thinking of retirement. And then the middle-aged part of the workforce immediately behind them, again, actually lost a large amount of employment. The people in their 40s and 50s. There was recently a shocking study that was published around the world that showed that exactly that part of the American workforce is killing itself. That they've had growing death rates for the last 15 years. They've been killing themselves with drugs, with alcohol, by committing suicide, by liver diseases, because deindustrialization has simply taken away what they thought would be their productive life. And these have continued, even when you see these reports of 250,000 jobs created in the United States. The pattern every month is the same, that the core of the American labor force is who had the good jobs, who had the productive jobs, well-paying jobs, they are losing that. And then you have this very strange phenomenon of older people with 3 jobs because they have no hope of getting through retirement with the money that they have. So this will make things difficult, but obviously the way forward is very clear in terms of where the investments should go.
Okay, brilliant. Look, Paul, I think we're just about out of time for this occasion. I'd like to have you on again in the not too distant future. Hopefully the situation won't be too much worse by then. But thank you very much for joining us. Tell us where we can find out more about, give us your website details and so on, and details of any of the more recent reports that people should be getting hold of.
Sure. The most active website is www.larouchepac.com, LAROUCHEPAC, larouchepac.com, which is constantly updated and reports on our activities every day, as well as intelligence matters. And right there now is a report we just finished called the United States Joins the New Silk Road, on where these investments would go in the United States and what they would do. Then there's also www.larouchepub.com with a PUB for publications, where our weekly magazine appears. But to really follow us and join in what we're doing, LaRouchePAC.com is the action center for what the LaRouche PAC movement is doing. And thanks a lot for having me on. It's been a pleasure.
Thank you very much, Paul. And thanks for everybody for watching today. And we'll see you at the same time tomorrow. Thanks. Bye-bye.